Hi, I'm Rob.
And I'm Rob.
And this is Ask Rob and Rob.
Hey everyone, it's Ask Rob and Rob, the show where you give us your lovely questions in, normally property related, and we give you our answers back. It's a very simple concept. And we make it very easy for you to get your questions in as well, which has probably helped that run.
Yeah, I think so. All you've got to do is go to propertyhub.net/ask. Really is as simple as that. From there, you can send us a written question if you want to see your name in the Sunday Times, or arguably even better, if you want to get your voice on the podcast itself, then you can leave us an audio message. Okay, let's have our first question from Kishan.
Hi Rob, my name's Kishan. I'm a portfolio landlord of 5 properties. I've been listening to your podcast for some time now, and I'm grateful for all the wisdom you share on a weekly basis. I have recently purchased a property via the Property Hub Invest, and I'm looking forward to adding that to my portfolio in the near future. My question is twofold. Firstly, starting with remortgage of existing properties, which several of mine are due now. I've been presented with a variety of products, which range from those that have high arrangement fees to others which have no arrangement fees at all. On the whole, after doing the maths, it works out more economical to take the mortgages with higher arrangement fees. But I wanted to ask how you approach this. Do you tend to absorb the cost of the higher arrangement fee into the mortgage if that's available, or would you tend to pay that mortgage arrangement fee up front? And this sort of leads on to my next question, which is around mortgage debt in the portfolio as a whole. Do you have a strategy on how you go about managing that mortgage debt, or a guide as to when you would think about trying to pay it down, if at all? Because my concerns would be that approaching retirement, I want the mortgage debt down quite significantly, so it's a lot more comfortable to manage. But I just wanted to know your thoughts on that. Thanks very much.
Thank you for your question, and thank you for working with us. So I think the least we can do in the circumstance is permit you your 2 questions. So first one, on the arrangement fees. As you've rightly said, there's always a combination of rate and fee to look at. And your broker should be able to tell you the total cost over the fixed term of the loan of those 2 options. And so they've probably done that for you, which is how you have come to the conclusion that the loans with the higher arrangement fees work out better. So then your question is, well, do I pay that fee up front, or do I add it to the loan? And for this, there is no hard and fast answer. If you pay it up front, then that means that you'll be paying less interest over time, because when you add it to the loan, it makes the amount that you've borrowed, therefore the amount that you're paying interest on, larger. So your mortgage payment will be very slightly higher each month than it otherwise would have been. And that means, of course, that you'll be paying out more interest over the term of your loan. However, the advantage, of course, of not paying it is you haven't paid it. You've still got the cash. So it really is just weighing up those 2 factors. Personally, I tend to add the fee to the loan, because if the property still makes money, even when taking that slightly higher mortgage payment into account, then I'm happy. I'd rather just have my cash, because it gives me optionality. It takes me closer to investing in something else. Or depending on your circumstances, maybe that's your emergency fund or whatever. But this is one where I'd say there is no right and wrong. I know investors who always pay their arrangement fee in cash, and I certainly wouldn't say that they were wrong. It's just personal preference. Your second question is an easier one, which is about your mortgage debt and how you manage that over time. Well, seeing as you've just bought now, that means you must have a time frame of at least 10 years, hopefully more. And over that period of time, if you don't extend your borrowing, so if you borrowed, say, 70-75% of the property's value, and then as it goes up in value, you don't borrow any more, you just keep on refinancing and you leave it at the same level, then your loan to value takes care of itself, because the amount you borrowed stays the same and the property value goes up. So even though the amount that you've borrowed in absolute terms is the same, it doesn't change. As a proportion of your portfolio's value, of course, it shrinks. So by the time you are approaching retirement, you will have a far more manageable amount of debt, because your debt will be lower relative to the purchase price and relative to the rent the property brings in and relative to everything else. If at that point you have a portfolio, so you have more than one property, then of course you've got the option of selling just 1 or 2, which might be enough to clear the debt on all of the rest. And at that point, you're completely mortgage free. So that part, Kishan, I think is really simple. That is the beauty of investing for the long term, and the beauty of having a portfolio rather than just one property, because then you've got options. So congratulations on your purchases, and I hope that answer helps.
Right, next up, we've got a question in from Gareth. Let's take a listen.
Hi, Rob and Rob. Hope you're both doing well. Gareth here from the Wirral. I've been a long time listener of the podcast and just wanted to say how much I appreciate the content you put out. The way you break down investment topics is brilliant, so please keep up the great work. I have a question about property crashes. Now, of course, we're not expecting or hoping for a crash anytime soon, but at some point, it's bound to happen. I was wondering, how is a property crash actually defined? Is there a specific percentage drop that analysts will use? And are there any steps us investors can take to protect our portfolios from the impact of a property crash? Thanks for taking the time to answer my question and keep up the fantastic content.
Well, Gareth, as I spent many happy years on the Wirral, I had to answer your question. Lots of people don't actually know where the Wirral is. It's near Liverpool for those who don't know. It's a peninsula. But anyway, that's enough on the Wirral. Let's get Gareth's question answered. And it's actually an easy one for me, Gareth. A 10% fall is normally defined as a correction, and a 20% fall is normally defined as a crash. I say normally because there's no hard and fast rules on this, but I think it's more of a general acceptance that 20% is a crash and 10% is a correction. That said, if the property market fell 18%, is it going to stop the Daily Mail calling a property crash? Absolutely not. So that's why I say it's not a hard and fast rule. It's how people will interpret it. And it's also how it feels as well. If it's very slow, people may not call it a crash. They may call it correction, say a slow drop of 16%. But if the property market dropped, or any market dropped 16% in a very short space of time, I think a lot of people would be more inclined to call it a crash. But as a general rule, 10% correction, 20% crash. Can't see it anytime soon in the UK property market, as we've talked about many times, and I know you acknowledge it's a long way off as well. We have had a silent property crash, which we talked about on the pod. Absolutely go back, search for Silent Property Crash, Property Podcast on your favourite search engine, and you can find that. Go and listen to that. We have had a silent property crash, but in terms of a real crash that people have taken notice of, it's not happened and probably won't happen for a long time yet.
Well, 2 more questions answered, and we'll be back to do it all again next Tuesday. But before then, we will see you on Thursday for the Property Podcast. Have a great week till then. Bye-bye.
Bye-bye.